Hi, Eric. How are you?
Morning, Adam. Good. How you doing?
Good. Thanks, everybody, for joining us. Got a nice cold day here in New York. Why don't you give us an update on what's going on in your neighborhood? It's been a terrible disaster, and give us an update on your situation and the neighborhoods.
Yeah, so again, there's two core fires. There's one in the Palisades, which is like the Malibu area, and then one in East LA, which is Pasadena. They're both not really spreading. There's another issue, I suppose. This week the winds kind of come back up to 100 miles per hour. So the
Oh,
worry is that even though these things are, 20, 30% contained, the winds can very easily take them
right.
anywhere. So we have no smoke overhead, but when the winds shift, we smell fire
Yeah.
still. So we're not really out of the woods here.
Yeah. All right. Well, be careful. Um, well, obviously, we just had the inauguration over the weekend. I guess this surprise is that there was no real surprise. There was no real shock and awe. Uh, President Trump did sign a lot of executive orders, but it's kind of left ambiguous, kind of one of the bigger ones. Uh, Meanwhile, he got rich again by issuing a coin. I guess the Trump mem coin, and I guess it's made him a billionaire a few times over, but it's obviously a wild concept. I mean, the idea that there's nothing behind it other than I don't know what's behind it. I mean, it's kind of like those images that you used to sell for quite a bit of money that now probably sell for nothing. But Eric, I like the idea so much that I've decided to introduce the Maximus, and that's Max there. Max was supposed to make an appearance here, and he just left. So Max has left the room. He does kind of look a little bit like Elvis, I guess. But we could do this for Yo-Yo as well. Anyways, let me we'll, we'll see if there's any interest in anybody buying this currency. But Eric, on a serious note, the thing that always kind of intrigued me is that yeah, Bitcoin, it's only like 21 million coins that this thing is programmed to mint. But then again, there's an infinite number of new coins that can be created and have been created. So while the supply of Bitcoin may be limited, the supply of cryptocurrencies is not. Um, and so that's been kind of an issue for me. But my my uh, my only regret is that I didn't buy Bitcoin. I mean, it's been great, and I guess it's really based on the idea that as long as there's some other sucker out there willing to buy it, I shouldn't use that word because I'm sure people get really mad at me. As long as there's some other buyer out there that's willing to buy it at a higher price, it's going to go up. And I've compared it to the the mania in Amsterdam. I've called it digital tulips. But I don't want to come across as being negative on this concept. Digital tulips analogy means it can go a lot higher because the tulips mania was just in Amsterdam and it was just a very local market and it was only open during the day, I presume. It wasn't 24 by 7. Bitcoin and cryptocurrencies are 24 by 7 and on a global basis. So there's always potentially, I guess, more buyers. And if the United States government is going to create a Bitcoin strategic reserve, and if states are not talking about it, I guess it really is an amazing fantasy. The idea that the U.S. government could buy Bitcoin, this Bitcoin goes up, and then all of a sudden we can pay off the debt with all this Bitcoin. I don't know that I want to be there when the government announces it wants to sell Bitcoin, but anyways, we're diverging from what we know something about. That's bond stocks and financial markets, other than cryptocurrencies. Though I think you know more about them than I do. So look, let's talk about uh, the implications of Trump 2.0 for our three scenarios. You know, the roaring 2020s, the the inflationary 1970s, stagflationary 1970s, and then the melt up 1990s. Eric and I thought about it, and we're kind of leaving the probabilities the same as 55% for the roaring 2020s, 25% for the melt up scenario, and then 20% for the kind of what could go wrong bucket, the 1970s. But we kept throwing more issues in there. Eric, let me just kind of review these and let's discuss it. So, in the what could go wrong bucket for a while there was monetary policy was tightening, and inflation was an issue. Now monetary policy isn't tightening, and Fed officials are talking about still lower interest rates. But we aren't necessarily getting quite at 2% on inflation. So there, I guess we could still leave that in the bucket that if inflation continues to be somewhat sticky, maybe the Fed will at least pause, which seems to be what they're inclined to do now. But then Chris Waller, who seems to be running to be the next Fed chair, muddied things up last week by saying, well, there could be 3 to 4 more rate cuts. So that's one negative in the bucket. Another one that we've had is geopolitical crises leading to higher oil prices. Biden, as he left, decided to tighten the sanctions on Russia, so the oil price went up. So maybe that's still an issue. And then, of course, if we can't get a recession and bear market on tight monetary policy or a geopolitical crisis, maybe now tariffs will do it. They did it. They ended the 1920s with a thud when the Smoot-Hawley tariff was passed in May of 1930. And then last but certainly not least, and maybe foremost these days, is a potential for a debt crisis. What are you thinking about all those four? Give us a little update on monetary policy and what Chris Waller said last week.
Yeah, Waller, his path or his campaign to be next Fed chair seems to be predicated on thinking Trump wants lower rates. And I think it's interesting that Kevin Warsh took the opposite approach, kind of criticizing the rate cuts in the Wall Street Journal. But he's saying, the neutral rate is still lower. We probably have room to cut as long as inflation comes in a bit softer. We had a pretty encouraging PCED, the prior reading. So I don't think that is as, consensus on the FOMC anymore. I think a lot more hawkish rhetoric is coming out in the commentary, and especially the newcomers, Musalem and Schmid. They're starting to, they're taking private sector experience and basically saying, look, the 10-year went up pretty drastically after we cut. The economic data remains strong. It's pretty clear, at least from the bond market's perspective, that we didn't really need to do these and at least don't need to do them any further.
Yeah, but I think, in terms of, I think we're going to just keep monetary policy in the what could go wrong bucket in the sense that, if inflation, we have to have something in there. So, if monetary policy kind of makes sense that maybe some people think it's still restrictive. I mean, there are people at the Fed who think that. And if the consensus decides that they actually want to pause, and that's the wrong thing to do because we're wrong and, Fed policy is too restrictive. I mean, we could still have something blow up in the commercial real estate market. Maybe there's a lot worse to come in the housing market. And maybe they should be lowering interest rates a lot more because they've always done it in the past. But in the past, they always did it because there was a recession. So let's just leave it there, but leave it in that bucket. The other thing is geopolitical crises, and it's, that's obviously diminished somewhat. It appears in the Middle East. Israel seems to have redefined the whole military balance of power in the Middle East. And the question is whether the Israelis will ask for and get permission from the Trump administration to just go ahead and bomb all the nuclear facilities in Iran. Who knows how that goes? There's a temporary ceasefire here between Israel and Hamas. Meanwhile, Hamas is coming out of their tunnels and all that. seeming emboldened. They think they actually won something here. Maybe the Israelis will feel that the only way to continue to deal with this crisis is take out Iran so that Hamas is totally unsupported. Hezbollah certainly is not going to do it. The Houthis aren't going to do it. And maybe the Israelis will feel that they got to do something with Iran. So that's still a possible scenario that would lead to higher oil prices. But then you've got Donald Trump saying drill, baby, drill, and issuing a lot of leases all over the place. And if these leases are for properties that are easier to drill, the cost is lower for getting the gas and oil out of there, that would lower global oil prices. So let's keep it in the bucket of what could go wrong and say that it's not going wrong so far. So, maybe we should start thinking about the 20% for what could go wrong is too high. But then there's tariffs, which is a relatively new thing with Trump in office. So we have to consider that. Any thought on? I guess you're doing some work for tomorrow on tariffs. What are you thinking on that issue?
Yeah, we got a little whipsawed, at least in terms of the dollar. Initially the WSJ report that there won't be tariffs on day one kind of took some air out of the dollar, and then Trump obviously said 25% tariffs on Mexico and Canada could come as soon as February 1st. So I mean, it's all kind of up in the air. I think that's what everyone kind of expected, but it also does speak to the dollar is up a substantial amount. 15% over the past few years. There's at least some chunk of that that's baked in at least uncertainty or prospective Trump 2.0 policies. So the whole tariffs are enacted, the dollar strengthens, and that puts pressure on emerging markets and stuff. It might not be the same this way around. I think markets might have gotten ahead of it, but we'll see what happens with tariffs. It appears that they're waiting to do more work, at least in terms of China, on what path to pursue.
But from what you're looking at, you think that there's any possibility this turns into the Smoot-Hawley tariff and causes the next depression that will have kind of all sorts of trade wars and currency wars and all hell will break out, or we're nowhere near that?
No, I don't think so. I mean, the rumors have been, maybe a gradual uptake in tariffs or try and target critical minerals. I think the sweeping tariffs, the idea behind it is to, make sure like China can't export via Vietnam or Mexico. But overall, I think it's more, let's make sure the US protects domestic
Yeah.
manufacturing, but doesn't elicit, some sort of trade war. But I mean, during Smoot-Hawley, like we were way more dependent on trade and exporting, and just like the way our economy worked looked much different. I don't think it's the same story this
Yeah,
time.
that's a really good point because I think the U.S. The rest of the world, I think, depends on the U.S. more than we depend on the rest of the world. I mean,
Yeah.
that's a little bit of a caricature and a little bit of naive, obviously, but on a relative basis, compared to what was going on in the 1920s, I think that's a fair statement that the world depends more on the U.S. And so Trump is just, he loves to raise money, and he's just kind of charging an entrance fee. You want to come in and do business with the United States, you got to pay a tariff. And we've looked at it, and if nothing else changes, and you slap a 10% tariff on our imports, you get about $425 billion at an annual basis. From that, if you do 20%, you get over $800 billion. I have to believe Trump desperately needs revenues to fund tax cuts and all the other things that he'd like to do. I think Trump is in the same position that Clinton was, a similar position, I should say. Clinton got advised by Robert Rubin and James Carville that he didn't want to mess around with the bond vigilantes, and he had to maintain a certain amount of fiscal discipline. And Clinton really took that to heart, and actually there was a surplus by the end of the decade. I think Trump is probably getting advice from guys like Scott Bessent that you don't want to mess around with the bond market, and there's a limit to what you can actually do, and we have to have offsets. So we'll see how that plays out. But I think we can leave tariffs and what could go wrong, and maybe that's enough to keep the bucket at a 20% subjective probability. Then the last thing is debt crisis, and I've been doing this for a little longer than you, Eric, and I've been noticing over the years that the perma bears, the pessimists have been saying, well, the deficits are going to come and get us, and that's going to cause calamity and for the economy and bear markets. And my position over the years has been, well, when the bond market cares about the deficit and the debt, I'll care about it. So I did care about it last year, September. Well, I guess it was September, October, no, August, September, October. We had the bond yield go from 4 to 5%. That was actually 2023,
20,
right?
yeah.
Yeah. Or was it last year?
No, it was
No.
2 years
Yeah.
ago.
Yes. So it went up it's significantly by 100 basis points. And Janet Yellen came back and said, well, I'll just issue bills instead of bonds. And inflation moderated. And so that calmed the whole situation down. Now we see the bond yield up again by 100 basis points. A lot of chatter, including us, that it could get to 5%. The pessimists saying it could go a lot higher. But we thought that 5% would draw a lot of buyers. Well, 4.75% attracted a lot of buyers, and it didn't take much. A little moderation in the inflation rate, and Waller saying some dovish things brought the bond yield back down to 4.5%, which, by the way, Eric and I have been saying is just about where it should be. 4.5% plus minus 25 basis points is our view of what's normal and where the range should be for the rest of the year. But obviously, we can't rule out a debt crisis. So I guess the bottom line after talking about it, Eric and I thought that we're just going to stay pat with the three scenarios is kind of where we're at. Let's do the charts real quick, and then if any of you have any questions for us, so far the Q&A board is empty. So maybe we've been amazing at answering all your questions, though I certainly doubt that. So we would welcome any questions you have for us. So without further ado, let's see if I can share. So this is somewhat related to the three buckets, the three scenarios. Um, there was a lot of relevant fears about a potential debt crisis as the bond yield rose from by 100 basis points since the Fed lowered the Fed funds rate by 100 basis points starting September 18th. We got up to almost 4.8%. Then in the past week or so, we're back down to 4.5%. So that takes some of the pressure off the idea that we got an imminent debt crisis. I think Trump bought some time with the idea of Doge and that there'll be efforts to cut government spending. I think he bought some time with Scott Bessent, who's viewed as kind of one of us, somebody who knows markets and is going to advise the president to be careful when it comes to the fiscal situation. Stock market, the S&P went below the 50-day moving average. The fact that this market has so much power and doesn't come back to retest its 200-day moving average suggests that it's in good shape. And last week, one of the things that we got right was that bank earnings would be better than expected, that the earnings season would be better. And we're now raising our earnings target growth rate for the fourth quarter of last year from 10% to 12% year over year. The analysts have raised it from 8 to 9%. Here's the headline inflation rate. And Eric, Waller, what was the point that Waller made about inflation? Didn't he say that we've had several months of pretty good inflation? And we've been looking at the sticky stuff, but when you look at the overall CPI and take out the stickiest stuff, which is less shelter, it's been running around 2%. What are you thinking about that?
I'm a little skeptical. If you take out shelter because new market rents are much lower, ostensibly 2 years ago, shelter CPI wasn't high enough to reflect how high home prices really were. So I don't know. Maybe he'll be right. I hope so. But
Yeah.
it doesn't. Shelter CPI needs to start coming down quicker. It's been stickier for a lot longer than most of us expected.
And I guess the other thing is, as we've observed, is the the sticky areas haven't been just rents. There have been other services areas that have been sticky, and that most of the really good news has been on the durable goods inflation rate, and even the non-durables with energy prices being down. And now, at least in January, we're going to have energy prices back up, and if we see that the pace at which durable goods prices stop falling, we stop having deflation. That could that could at least suggest that we're not at 2% and we're not getting there anywhere anytime fast. Meanwhile, the market 2 weeks ago concluded that maybe we won't get more than one rate cut, and then last week said, well, maybe two rate cuts. So this is a moving target, obviously, and expectations. We're still kind of like in the one, two, or maybe even none and done camp. Um, we're certainly not in Waller's camp that says that 3 to 4. I think 3 to 4 implies that the neutral rate is 3%, and we think the neutral rate is kind of where we are. And the idea there is the Fed has achieved its mandate, and the unemployment rate is 4.1%. The inflation rate is pretty close to 2%. So why do we need to lower interest rates exactly? And so why are we objecting to them lowering interest rates? And the idea, I thought, is we don't want to melt up. We just want a nice civil stock market going higher and higher. We've looked at this chart before, just showing the irony of the Fed feeling they're too restrictive and they have to lower the Fed funds rate by 100 basis points. And meanwhile, the bond market tightening by 100 basis points. This is the Fed's long run federal funds rate target. They've been slowly raising it to 3%. When do we get the next one, Eric? When is the next projection by the FOMC?
Yeah, it should be March.
Yeah, so in March we'll see whether they march higher, right, or keep it there. Um, oh, the rest is a little bit on China that we had. That's the other better than expected news out of China. Kind of relieves some of the anxiety that China might be imploding. They're imploding slowly, is our view. And then we reviewed the fact that one of the reasons the U.S. economy is so resilient is because household wealth is at an all-time record high, and we showed the various categories of assets that are being held, and they're substantial. So consumers are in good shape. Why don't we, let's see, I guess I had some more on that here, but you folks can look at the morning briefing and get our take there. Eric, you want to field a few questions?
Yeah, we have some good ones in here. So this first one is from Charlie Rose. What are the implications of a deglobalization, America first narrative?
Well, I think America first does not imply that we're totally isolationist. I think if you tell me if you agree with this, Eric, but my thinking is that what Trump really wants to do is say America is the most powerful economy. A lot of people depend on it. You want to do business with us. You've got to it's got to be a quid pro quo. We got to feel good about it, that we're not being taken advantage of. Again, you can agree or disagree with this, but this is this is the official statement of the current president of the United States. And I don't think he's saying he doesn't want to play. It doesn't want anybody else playing in the same sandbox with us on a global basis. He just wants everybody to realize we're the biggest players in the sandbox, and that has to be respected. So I think he's not shutting off world trade. He wants to continue to do trade with Mexico and Canada and maybe even China. He just wants it to be more of a even Steven situation. And if it's not, then he wants the United States to at least collect some revenues with tariffs. So it's a different kind of globalization. I don't know. What do you think, Eric?
Yeah, I mean, two key stories this century, since China entered the World Trade Organization is one, the labor share of GDP in the US has fallen from 60% to 52%. And two, our manufacturing and capacity have completely stagnated since then. So these are two things that I know Besant was talking about during his confirmation hearing, but that's not like a deglobalization necessarily. That's let's rebalance things so that certain areas of our production or consumers or workers aren't losing out due to unfair trade practices.
Okay, want to do another one?
Sure, this one is from Cagdis. Ed, given the initial tone of Trump on the inauguration day and the nature of the announcements thus far, do you think market volatility in both bonds and equities comes down or goes up?
Eric, take it away.
Yeah, I mean, stock vol is pretty low. Like we've been sub 20 on the VIX for a long time. Ostensibly, it's cheap, but I think bond vol is a more interesting story, especially if you want MBS spreads to come in, which they've started to. I don't know. I think we'll see what the QRA looks like. I think a lot of people started to talk about term premium for the past couple weeks as we got closer to 5% on the 10-year, which is really funny because that's what I was writing in 2023. So I don't know. I thought it was a pretty good contrarian signal. And, we're right around 4.5. But it'd be hard for, given how low realized vol is and, where the VIX is, I think it'd be hard for stock vol to come down. But hopefully bond volatility comes down. It's been kind of sticky-ish, high-ish, but we'll see.
Well, in our story, the 4.5% is kind of the right level.
Yeah.
And in our story, the volatility should come down. It should be, plus or minus 25 basis points. It shouldn't be like 100 basis points in a couple of months to the upside
Mhm.
or the downside. And to the extent that the volatility in the bond market has fed the volatility in the stock market, maybe that's an argument for volatility in the stock market to calm down as well. Again, in our base case scenario, the market goes up on earnings, and that's presumably, given the way we're looking at the economy, a less volatile environment than a markets that's driven by valuation multiples. Just just a thought. Go ahead.
All right. This next one is on sentiment. So the AAII signal and investors intelligence bull bear ratio had a big drop last week in terms of bullishness. The S&P 500 rose obviously. And then we had one of the best breadth weeks in the history of the S&P 500 or proxies. I think you noted, Ed, that also the SMID caps did pretty well over the past week or two. So what are our general thoughts on that? And maybe just breadth and broadening out in general.
Well, it's been a funny kind of 2 weeks, right? A week ago, the market tanked on better than expected non-manufacturing PMI. I think that was on a Tuesday, and then on Friday we got the payroll employment, and the market freaked out on that because uh, the fixed income markets concluded that there's only going to be one rate cut after all, and it might be in October or much later in the year, and so we had a big sell-off in the stock market, and then last week, we had a better than expected PPI, then a better than expected CPI, then we had better than expected bank earnings, and then Chris Waller said some dovish things, and the market completely reversed itself, and we saw that in sentiment. So we really haven't had much of a correction at all. I mean, it's been a pullback. Pullback in my mind is 5 to 10%, but I think it on average, most of the indexes were on average down maybe by about 5%. So we had a pullback, but we definitely had a correction in sentiment. I mean, sentiment went from like 3.5 and the bull bear down to like 1.2 or something like that. Just a real wicked change in sentiment. And that was such a swift change that we went from that being as a contrarian indicator, it went from being bearish to bullish, like in basically a week. So we're seeing the volatility in sentiment, and maybe that's another reason to think that the market might settle down if we get most of the volatility in people's heads instead of in the market. That might be an interesting development. But yeah, I think there is something to be said that when you take a step back, we have had a dramatic regime change between Biden and Trump, and the regime change on balance should be very pro-business. We did have a few billionaires sitting there in the inaugural uh, uh, events, and it's a very, very pro-business approach with deregulation. He didn't mention tax cuts, but I think he still wants to at least cut the corporate tax rate. So all in all, I think we got a good environment for the stock market. except for valuation, but earnings should be good.
Um, Really quick, if we want to touch on the dollar or oil, I
Yeah,
think that
you can take that. Go ahead.
sure. Yeah, in terms of the dollar, like I said, it's up like 15% over the past 2 years, 3 years, to be exact. One of the big stories there is going to be if the Fed actually does pause or, cuts only once or twice this year, there's just going to be a big rate differential. So whether people think the dollar is overvalued or not, if Europe keeps cutting, Japan's rates are quite low, China's currency is weakening. It's just like America's really the best of the bunch in terms of advanced economies. The dollar is going to stay strong, and whether it's tariffs or high bond yields, there's a lot of upward pressure on it. So maybe there's some volatility, and as certainty kind of arises from Trump 2.0, it deflates a little bit, but I think there's a lot of reasons the dollar is quite high. In terms of oil, I think it's encouraging to see WTI down 2-3% this morning. Trump is unleashing deregulation and promoting drilling, but they're also going to refill, he said, the strategic petroleum reserve. So maybe buy like 300 million barrels of oil. Tariffs on Canada would potentially limit oil. So I don't know. I think all said and done, there's so much to it in terms of deregulation for energy companies and oil and gas exploration that it's definitely a negative for oil prices. And the U.S. is increasingly a bigger and bigger player in terms of oil exports. We're a net energy exporter, so we'll see what
Yeah,
happens. But yeah,
yeah. I mean, Trump a couple of times in his various speeches, and he loves to talk. That's for sure. Mentioned liquid gold, referring to oil.
yeah,
I really think he views that as the biggest asset that he's got to play with for the U.S. economy is just making all this oil and gas available. Um, and so I think he, he does he does view lower oil prices as the best way to deliver on his promise to lower prices generally. Because I mean, he's right. I mean, energy is a huge component of producing and delivering a lot of goods, and it could be a very powerful disinflationary force. And but geopolitically, it's a very powerful weapon. It's very Reagan-esque. If you can get the price of oil down, you really weaken the oil producers, the axis of evil oil producers like Iran, like Russia, like Venezuela. So it accomplishes a lot. And the fact that he, is moving right ahead on deregulating energy and held off on tariffs, I think says a lot about what he, a kind of a practical side of him, which is, he knows for sure that's all going to be positive. Whereas tariffs, he's got to be a little bit more careful about the market reaction. It's not, I think we all know that he is still kind of views the stock market as a almost a daily poll of his administration. So I think we've got a lot of influence over the president of the United States. Eric, I think that covers it. I think Bob asked a question on oil. We covered it. If not, join us again next week, and we'll field your questions. And we thank you for joining us. And Eric and I will go back and decide whether we want to have a Maximus coin to convert the Ardenia Research into a cyber currency firm. Thank you, everybody. Thanks, Eric.
thanks, everyone.